Welcome to Behind the Data. I'm Jeff Krimmel, founder of Krimmel Strategy Group. Each week, I take you behind the energy market analysis I'm publishing online. I talk about what surprised me, what I left out, and what I'm still thinking about. And before I get into the first post that I want to talk about this week, I want to mention Oil and Gas Market Mastery, the 12-week program that I built to help oil and gas professionals develop executive-level fluency in oil and gas markets. We kicked off the second cohort of that program last week. So we are one session in. The second session we'll do this Thursday. If building executive-level market fluency is on your wish list, I recommend you check it out. You can easily jump in and catch up after the first episode. And join us already. This second cohort is starting out to be a super fun, impressive group. And with all the geopolitical ongoings in the world today, we have a lot to talk about and a lot to organize our market analysis conversations around. So if that interests you, check it out. It's at krimmelsg.com/OGMM. With that said, let's jump into our first post, which I wrote about SLB's earnings results that they published last week. It was their earnings results from the first quarter of 2026. These always the big OFS earnings results interest me. The SLB one was uniquely interesting this quarter as I read through the press release. It's one of the first things I do when any major, not just oil field services company, E&P, midstream company, downstream company, power company, investor-owned utilities, whenever any of them report, I take a few minutes to read through the earnings press release. They'll typically share that online in either HTML form or PDF form. It's an easy read. They design those press releases mainly for investors, but they are readable even if you're not an investor. And just the structure of those announcements gets very interesting. They, of course, lead with what they think is most important, what they want investors to pay most attention to. And then they'll give you more information as you go. But the ordering matters, the word choice matters, the organization matters, how they present different information. One of the things that grabbed me about SLB's earnings release last week was its use of the phrase energy security. And it used it in this quarterly report. It only used it in one quarterly report one time in 2025. It's not shocking with the Iran war ongoing that we'll have more conversations about energy security and the importance of oil field services companies positioning themselves in a way where they can support the broader push toward energy security. That alone was expected, I suppose. I created a word cloud based on the text that was in the earnings press release from SLB because I just got a sense that it was a unique combination of words different than they had been using as we went through 2025. And when I created that word cloud, which I posted on LinkedIn and on the KSG blog, two words lived at the center of the word cloud. And those words were digital and production. Both of those have been known pursuits for SLB. Back in the third quarter of 2025 is when they carved out digital into its own business segment. So for the past small number of quarters, we've now had revenue and pre-tax earnings looks into the digital segment for SLB. And on the production side, that was one of the huge motivations for SLB to buy ChampionX. They wanted more exposure to that phase of the oil and gas life cycle, to mature wells that are already producing where there's ongoing intervention required to maintain production, to maintain those flows, possibly to increase flows as time goes on. And that was underrepresented in the SLB portfolio before the ChampionX acquisition. So those two living at the center of the word cloud in a vacuum aren't very surprising, but they both took on more salience right now with the energy security conversation, with what's happening with the Iran war, with the uplift that we're seeing in oil prices. SLB's management pointed out what we've observed, which is that oil and gas producers are not racing to expand production, even though oil prices are much higher now than they were before February 28th when the U.S. and Israel launched combat operations in Iran. Even with those much higher oil prices, we're not seeing an aggressive expansion of capital programs. We're not seeing new rigs get deployed. We're not seeing well construction programs ramp up aggressively. Where production can go up cost effectively is largely from the mature well side. And SLB's management leaned into that there are low cost, low commitment interventions you can make to try to ramp production up on the margins that don't require huge capital expenditures, that don't require you to go back to the market and explain why the capital program you entered the year with is now no longer satisfactory and you're going to make some pivot. These are operating costs that would be more or less planned to some extent anyway, and now it's just a matter of clustering that spend in a way where operators can take advantage of these higher oil prices. So SLB is leaning into that through their ChampionX purchase. It makes sense that they're going to try to broadcast as much of their activity on the production side as they can. Not only are market forces aligning in that direction, but this is a way for SLB's management to remind investors about how well-placed the deal with ChampionX actually was. So this commentary makes a lot of sense. The digital side is ongoing commitment and narrative from SLB, but we're at a point right now where the returns to digital investments from oil and gas producers are even higher, and there's even more urgency around those. And that carries me into the second post that I wanted to talk about, which was last week I was invited to give the opening talk at the Xait Forum here in Houston. Xait is a European software provider that basically has two big tools. One is for organizing, preparing and organizing huge documents like tenders. The other is a CPQ tool that's used for pricing and executing on the pricing side of the equation. And so they have this targeted focus in the digital world. And when I opened up the Xait Forum, my talk was about how market forces are driving urgency in the direction of digital adoption. And a lot of these digital tools are fun to talk about. They're fun to demo. They're fun to understand about just how much advancement we're seeing in that domain. And all of that is perfectly fine. What I wanted to do is encourage everyone gathered in the room to appreciate the market forces are aligning in a way where there is more urgency and a larger existential element around the adoption of these digital tools. When we live in this world of capital discipline, where energy companies are being asked to generate more cash and invest less capital and do it in the face of increasing uncertainty, digital tools are an important response to all of those challenges. So we are past the point of engaging and indulging in the digital conversation just because they're really interesting technologies and just because they're now available to us and the world is moving in that direction. On the energy side, they're necessary. I titled the talk From Advantage to Imperative, that they did move from offering some measure of advantage to oil and gas producers, to energy companies more broadly, to now being imperative in the sense that this is the only way that these companies will meet the demands of investors in a market environment that is uniquely challenging. Oil and gas markets have always been turbulent. This one is challenging in very unique ways with how much uncertainty exists around the long-term demand trajectory for hydrocarbons writ large, but for any energy source. We just don't know exactly the way that our global energy mix is going to evolve going forward. And so I used the Xait Forum as a way to marry up this market force analysis with the cool whiz-bang element of digital tools. And to be clear, Xait has some awesome tools that were fun to see in the room and fun to hear about specific use cases, because a lot of digital conversation in oil and gas and in energy can be abstract and high level and a bit more evangelical, almost lecture style approach to it. And at the Xait Forum, we got to see real tools being used by real companies, talking through how their workflows have changed and what efficiencies they've captured as a result of using these tools. So it was a lot of fun to bring my market analysis view of the energy world and use it as a ramp into some really meaningful, more granular conversation about specific digital tools, but to help encourage everyone in the room to think deeply about how we can use more of these tools going forward. So that was a really fun engagement, and it was fun to write about and share about on LinkedIn and then on the the KSG blog. The last post that I want to talk about is GE Vernova. And they also reported, like SLB, they reported their own earnings results last week for the first quarter of 2026. And it was remarkable. They've seen equipment orders in the first quarter for the power side that exceeded all of the equipment orders that they had in 2025. that anecdote there grabbed me, like it probably did a lot of people that were paying attention to this, because it is easy to believe that the data center, the AI conversation, the broader electrification story is a lot of hype. We hear about it all the time. Every conference, it's what the business press writes about endlessly. We hear about it all the time. And my internal antenna is set up where I naturally want to believe that there's exaggeration and overindulgence in a lot of that conversation, just because it can be scary, it can be exciting. It's exactly the kind of thing that provokes and grabs the interest of people. And we live in a world where capturing people's interest is harder than ever, and maintaining a hold on that interest is harder than ever. So I am even more skeptical now than I have been in the past of instances where it looks like we're just trying to provoke and grab on to people's attention. The GE Vernova financial results are a way to calibrate all of this broader conversation of publicity with the dollars and cents implications. And for GE Vernova, they're massive. So it's a reminder that this conversation that we're having around AI and data centers, specifically electrification more broadly, there's real activity here. Real capital is flowing in this direction. And we also get, on the GE Vernova side, some really interesting an evolution of the utility scale version of the power story against the decentralized power story. This is a story that I'm paying a lot more attention to as time goes on. I've been invited to give talks at leadership retreats, and more of these talks are focused, that they at least have a power element to them if they're not outright focused on power. So it's an area that I'm spending a lot more time researching. I'm spending more time building slide decks around, engaging executive teams around, just engaging industry stakeholders more broadly. And when it comes to the natural gas element of the story specifically, one of the bits that's most interesting there is the backlog that remains on utility scale gas turbines. And the big manufacturers of utility scale gas turbines, which includes GE Vernova, it also includes Mitsubishi and Siemens, these manufacturers are profoundly hesitant to expand, to plunge a lot of capital into rapidly expanding their manufacturing capacity. They're concerned that while there's a lot of talk of interest in natural gas today, that demand won't be durable and that we won't see capital continue to flow in that direction over longer periods of time. There's the renewables build out, which continues at a super aggressive pace. Batteries continue to evolve. Research is aggressively steered toward long-duration energy storage. These are all elements that will compete in various forms with natural gas into the future. And so these utility-scale manufacturers, knowing how much capital is required to expand their manufacturing footprint and how long it takes to get a return off those kinds of expansions, have been very hesitant to expand. But at least the near-term gas demand is very real. And as time goes on, it's becoming clear that the gas demand is probably more durable, certainly than the skeptics would have imagined initially. And it's one of the reasons I pay so much attention to GE Vernova's earnings releases, is there's the utility scale element of the power conversation that we get a lot of visibility in through GE Oil and Gas. And then you have the distributed power version of this, and that's where you get the Baker Hughes conversation with their industrial technology segment. You get it with Caterpillar making a lot of these engines, and there's just a bifurcation here where, yes, more power is going to be needed in the future. And when you think of natural gas and the role of natural gas in this, is it going to come predominantly through building more combined cycle facilities at the utility scale that are super efficient and are the backbone of today's power grid that we have? Or are we going to see this evolution skew more in the direction of decentralized power, where large load sources like data centers or huge industrial facilities may want to secure their own power and pull it behind the meter and control it themselves and not expose themselves to interconnection queues? And that leads to a whole bunch of conversation around the regulatory element of this, that a lot of the friction that exists at the utility scale is both with these big manufacturers not wanting to get out over their skis, like I'd mentioned before, and around the regulatory footprint. That in the U.S. we do not have an effective regulatory regime that allows these new power sources to come to the grid quickly, get their connections in place, and allow new generation sources to meet the demand that is rapidly coming online. So there's a regulatory element to this. There's a capital allocation element to this. And the GE Vernova story leans hard on the capital allocation element, but it also informs the evolving regulatory conversation that comes on the back end. So that was the third piece that I published this week that I really wanted to go through the background of. I published all these pieces on LinkedIn. I also put copies on the KSG website, and that's at crimelSG.com. And you can go there and find copies of all the blog articles. They're just easier to find. When I publish them on LinkedIn, they vanish. They go away over time. They get buried. And so I wanted to put copies on the KSG blog where I can find them more easily. You can find them more easily. So feel free to look for that stuff there. And like I said, if building executive level market fluency is something that you're interested in, I recommend you check out the Oil and Gas Market Mastery Program. We're 1 week in. We have 11 weeks to go. I record all sessions. I upload the videos, the full transcripts. I create summary memos, audio summaries, the slide deck. There was a guy in our founding cohort that had to travel 4 consecutive weeks out of the 12 weeks, missed all those live sessions, and he said he made Sunday nights his time where he would sit down and listen back through the session, read the notes, reflect on it, and he said it felt like he didn't miss the cohort at all. He was still very much part of the group. So if that's something that you're interested, I recommend you check it out at crimelSG.com/OGMM for Oil and Gas Market Mastery. You can easily catch up on the first session and join us going forward. As always, thanks so much for joining the podcast here. Really appreciate it, and I will see you soon.